Welcome back to Business Today, and with that we are ready to move on to our next discussion, where we hope to talk about a crucial sector of our economy. So let's connect with the stock market segment. Yes, the banking system is the lifeblood of the economy, without which the financial system cannot function. And we hope to go into an in-detail discussion on this subject with Ms. Dilani Peiris. She is the Manager Research at NDB Securities. A very warm welcome to you, Dilani.
It's a pleasure being here.
Right. To start off our conversation, can you give us a brief overview of the banking sector composition in Sri Lanka?
Okay, the banking sector dominates the financial system, and if I speak in terms of total assets, it accounts for about 58% of the total assets of the financial system. And if you take the remaining, as the finance companies, the leasing companies, insurance, unit trust, all of that accounts for only that remaining 42% of the system. So if I go through the composition, the banking sector has two main categories: the licensed commercial banks, the LCBs, like the commercial, the HMB, so forth, and the LSBs, the licensed specialized banks, which was set up for more of the long-term lending, savings, and so forth, where you see the National Savings Bank, the SANAS, the Regional Development Bank, and all that coming under. LCBs are the most significant financial institutions in terms of the banking sector, and that is in terms of assets and also in terms of the magnitude of the services that they provide. If I further drill down the LCBs, we can have it as domestic LCBs and foreign LCBs. LCBs again accounts for about 87% of the banking sector itself, and then the domestic again accounts for about the 90% of the LCBs, and that 10% accounts from all those other foreign banks, which is about 12 banks itself. So that's how big the domestic LCBs are in the country. And if that again, let me just categorize it into listed domestic banks and the unlisted domestic banks. Of course, in the stockbroking industry, we are more interested in the listed space, and we see about 57% listed on the Colombo Stock Exchange. And then the remaining unlisted is just 3 banks, because of the 2 biggest banks in the country, the BOC and the People's Bank, with more than 1 trillion worth of assets, with the latest addition, Cargill's Bank, which is relatively young and relatively small. So that's in terms of LCBs, how it dominates. And one more point in terms of LCBs I would like to mention is that 5 banks out of the full 25, 12 foreign and 13 domestic, accounts for 71% of the entire banking sector. So
just 5 banks.
Just 5 banks. So it's dominates as well as it's highly concentrated.
Okay, what is your view on the future banking sector growth in terms of the contribution coming from assets and liabilities?
In terms of the banking sector growth, in general, it's highly correlated with the economic activity of a country. And it's the same case with Sri Lanka as well. If you see in the past 5 years, on average, the banking sector assets, which is dominated by loans, has grown about 3 times the GDP. So that is something that we expect in the future as well, to be around the same multiple. So if I speak in terms of loans, since it dominates the banking asset growth as well, we saw a credit pickup back in the 4th quarter of 2014, and in 2015 it increased further with retail loans peaking. We saw a fiscal loosening where it led to improved consumption power, and also we saw increased tax concessions in terms of imports. So because of that, we saw retail loans peaking, and we also saw central bank trying to curtail its loan back last year with some measures like loan to value ratios of vehicles, bringing it down, which we expect is because the retail loans in terms of vehicles, the economic benefit that it adds is a bit relatively low. And then further, we also saw last year, mainly because to loosen up the pressure on inflation, demand side inflation to be particular, and to support the balance of payments, the central bank went through a lot of monetary policy tightening as well. So this indirectly will also curtail the loan growth going forward. Just to elaborate a bit on the tight monetary policies, because that has been quite significant over the last year. One is the statutory reserve ratio. If you see, back in January, they had it on effect about from 1.5% being increased. We saw two policy rates increase last year, one in February, one in July, 50 bips each, and another policy rate hike this year in March of 25 bips each. So all this tightening, we expect FY17 to have a little bit of a curtailed growth of maybe around 15% compared to an 18% growth that we saw last year.
Okay, so we are also experiencing an increasing trend of interest rates. So can we expect this situation continuing? And what are your thoughts on cost of funds?
Like I said earlier, we've seen increased interest rates, and that has of course brought the funding cost up as well. Getting back into funding itself, just let me go through. So there are two main sources of funds that bank has funding. One is deposits, one is borrowings. The mix is around 80-20, I would say, where deposits is the main source, mainly via the physical branch network. Back to your question on funding cost, yes, it has increased significantly over the last year. Two main reasons. One is, of course, the interest rates increase, like you said. And the second is that deposits, where we consider low-cost deposits to be CASA, current account, savings accounts, has switched to fixed deposits, the higher-yielding interest rate components, because the customers obviously want a higher interest for their deposits. So what we see in terms of large banks is that they enjoy a higher CASA compared to the small banks. So that being the case, we saw about 1.5 years back, large banks enjoying about 40 to 50% of CASA from their entire deposit base, which has declined over and now is around 35%. Small banks also witnessed the decline, and that is around 20 to 30% of CASA levels that we see. In terms of LCBs, which were earlier development banks, earlier of course secured a lot of long-term funds via their credit lines, but we see NDB, DFCC getting into an LCB model and now trying to concentrate more on their deposits. So CASA levels we think would stabilize with interest rates also stabilize in the next couple of quarters. And also in terms of deposits, we saw consumption taxes coming last November, which we think would actually affect a little bit on the retail side of deposits. That's on the deposit front. And in terms of borrowings, borrowings about 60% is actually foreign currency borrowings that we have. And we've seen a slight 60% of foreign currency denominated, yes, and only 40% in terms of local currency. That has been a trend that has increased about 4 or 5 years back, which has now slightly declining actually. And in terms of local currency borrowings, a trend that we've actually witnessed is that banks actually started raising funds via listed debt on the stock exchange, where our interest of course comes in as well. But that we see is mainly due to two main reasons. One is the low interest rate environment that was prevailing in the last couple of years, and then the government also proposing an exemption on withholding taxes. But going forward, we think a bit of a slowdown in these debentures will come in, because of course we are in an increased interest rate environment. And the other is of course that the government is now trying to get the exemption out as well. So that is in a proposal stage right now. But still we think that with the total capital ratios with Basel that is coming in, banks might look at the option of still looking at listed debt via CSC.
Okay, you just spoke about Basel III.
Yeah.
So what can you comment on the Basel III requirements and its impact on Sri Lanka?
Sure,
Are we ready for it?
Of course we are. Because one, I would say, is Basel III is all about making the banking system resilient to any internal or external shocks. And in the past as well, I think the Sri Lankan banking system has been quite resilient to any shocks to the system compared to the other sectors. Two main reasons I would say is the industry practices and the stringent regulations that central bank also has imposed. So it's a matter of being strong and now being stronger in terms of the banking system. In terms of Basel III, like you say, right now we are in Basel II and we are trying to migrate to Basel III. Yeah, and then we've seen central bank imposing capital ratios, more stringent liquidity ratios, leverage ratios on all banks, LCBs and LSBs, the entire banking system. And in particular, we see central bank has also imposed further stringent capital requirements on domestic systemically important banks. These banks are identified by central banks as banks greater than 500 billion. These large banks, what the more stringent requirements are imposed, because what in terms of starting from Basel III itself, what they say is that the larger the banks are in terms of assets and the interconnectedness is much higher to the system. So in case something shock or something comes in, they should be much more stronger and stable in terms to face those in terms of higher levels of capital buffers. So we've seen recently in terms of capital ratios, there has been from 1st of July, a couple of days back, that ratios has been imposed where it goes on a staggered basis and we be on full effect from January 2019, which is more of the regional levels also coming actually in January 2019. So Sri Lanka has always been very trying to adapt into Basel to 1, 2, 3, so forth at very early stages. So in that case, I think we are quite in the comfortable zone as well. That's in terms of ratios, and but in terms of other definitions as well, this has got a bit more stringent. If we talk about a bit more towards the technical side, capital ratios are defined in terms of risk-weighted assets. So if you see foreign currency denominated sovereign bonds for Sri Lanka earlier had a 0% risk weighting, which is now brought into a 20% risk weighting. So a little bit of more capital to be added with respect to these investments. Even in terms of gold-backed loans, back in Basel II, we saw a 0% weighting given. But Basel III, with the new definitions and all that, we see for the risk-weighted assets, there's a 20% risk weighting given if there's a loan-to-value ratio of 70 to 100% for gold. So forth, we've seen additional capital requirements coming in terms of investing and lending. Of course, that will become a more sound system as well, more stable system, but of course, a little bit of hindrance in terms of aggressive loan growth with the additional stringent requirements. But in the positive side, it brings much more stability to the system, which will have sustainable growth going forward, rather than using sudden increases or sudden collapses. So which in general I think is a very good sign for the banking system going forward.
At the same time, the world is rapidly moving towards digital banking. So where is our stand and where should we move forward? Where should we move towards actually?
Virtual banking is something that on a global context has been discussed, and of course we see banks going into virtual banking as well. Just to say a little bit on the global context, we've seen two main factors as technology and banking reforms like Basel driving the competitiveness of the banking industry. In terms of technology, we see two main things again as internet penetration and smartphone penetration, and also the growth of e-commerce driving the digital banking. The growth in e-commerce has also led companies like Alibaba, Tencent and these companies offer competitive rates like banks do. It's almost equivalent to the banking services in the current context. So in that case, we see in terms of banking, not only being competing in terms of rates, but it also has to compete in terms of platforms right now. So it's a matter of which platform will give the most competitive rates in conveniently, safely and reliably. So it's a massive transformation going on a global context. But Sri Lanka, of course, is also trying to get into that transformation. We hear most of the banks speaking in terms of virtual banking, working towards virtual banking, but we see a little bit of a slow growth in terms of the shifting, mainly because I would say it's the technical side of it, and of course the safety precautions.
Right. So thank you very much, Dilani, for joining us today. We really, really appreciate your presence today.
Okay, thank you very much for you, actually.
Right. With that, we got to wind up for today. Thank you for being with us. We will be with you there next week, same time on channel.